So you've hit retirement and the numbers on your monthly budget are just not adding up. So you're staring at the biggest asset you own, your home. But here's the problem. All that money that's sitting in your home cannot help you pay for medical bills or groceries. Today, I'm going to break down 2 options retirees have for unlocking that equity in your home without monthly payments. I'm RJ Weiss, certified financial planner and founder of the Ways to Wealth. Let's dive in. Here's what I'm seeing more and more. Retirees with significant equity in their home, but they're also facing a cash crunch at the same time. Maybe your savings didn't grow like you hoped. Maybe your fixed income isn't keeping up with inflation, and your home might be worth 400 or 500,000 or even more, but that doesn't help you when you need $20,000 right now to pay for immediate home repairs. And traditional options like a HELOC usually require credit score requirements and income. And if you're in a situation with, say, bad credit and very limited income, you might not qualify for more traditional financing options. That's not to say these options shouldn't be looked at, but there are definitely challenges retirees have pursuing more traditional options like a HELOC. And it's in these situations that many people start turning to alternative options. These could be reverse mortgages or home equity agreements, which we're going to talk about today. In both of these scenarios, both promise cash up front without the monthly payments. But really, they work completely different, and choosing the wrong one could cost you tens of thousands of dollars down the road. Let's start with reverse mortgages because they're a little more well-known than home equity agreements. Here, you're turning your home's value into cash with a loan. And with this loan, you could take a lump sum up front, you could take a draw option, you could take consistent monthly payments. There's really a lot of flexibility with how this works. So some basic math on how this works if you're new to the concept is, let's say your home is worth $400,000 today. You take out a reverse mortgage for $200,000 up front. So over time, the interest and fees grow that $200,000 to $300,000, but also over time, your home grows to $500,000 in value. So when you eventually sell that home for $500,000, $300,000 would go to pay off the loan, and then $200,000 would go on to yourself, or if you pass away, your estate. The most common type of reverse mortgage is called an HECM. That stands for Home Equity Conversion Mortgage. So HECMs are federally insured and they're regulated by the Department of Housing. With this type of reverse mortgage, you must be 62 years or older. And another interesting thing about these is you're actually required to go through counseling to get approved. And this is really a good thing I see because there are a lot of bad actors in the space that try to take advantage of people. In the description below, I'm going to link to some good resources for you to check out on reverse mortgages so you can understand them thoroughly. But kind of going back to really one thing unique about these is you don't have to take all the money up front. You can choose something like consistent monthly payments or really take like a line of credit and just draw when you need to. So this gives you a lot of flexibility and just overall financial planning. And the nice thing here is you're only paying really interest on the amount that you've taken out. Let's now talk about home equity agreements, also known as home equity investments, or otherwise known here as HEAs. So this is not a loan like reverse mortgage, but what you're doing is selling potential appreciation in your home over time. Overall, here's a very simple example of how this works with the understanding that all agreements are really structured differently, but there's some key points in here I want you to understand. So let's say your home is worth $400,000 today. So an HEA company might give you, say, 10% of your home's value or $40,000 up front. And in exchange, they may take, say, 20% of your future home's value when you go and settle that loan, which can be up to 10 years later. So not every company structures this way. Some go up to 30 years, some 20 years, some 10 years. But the most important thing I want you to learn here is this is not like a one-to-one exchange where you're exchanging 10% of your home now in exchange for 10% later, and you guys will both grow in that appreciation. Another thing I like to add here is these are more non-standard options once you don't qualify for a HELOC. And as a very rough general guideline with, say, average appreciation, you're going to pay more than you would with good HELOC rates today. After studying these contracts a lot from all the different companies, I found that, the short-term contracts, 0 to 3 years, are when you often pay the most in terms of like effective annual interest rate. Those can be up to, say, 20%. In that 3 to 8 year range, they may come down a little to, say, 10 to 15%. Then they start to even out a little better the longer you hold on to your home, but then again, sharing more of your appreciation down the road the longer you hold the agreement. So another thing to keep in mind here, this isn't a standardized product. The example I just showed you was to just show you kind of how these work. You're going to have to dive into the details of the specific company you choose to really learn how the contracts work. Another big thing is there's an underwriting process, and that underwriting process, your financial profile, is going to have a big impact on your offer. So the worse off your financial profile, means you might not get the best terms in your offer, and then you might have to share more of your appreciation down the line. Also, unlike reverse mortgages, these things come with a pretty strict clock. The contracts range on the market from 10 to 30 years today. And at the end of 10 to 30 years, whether you want to move out of the home or not, you do have to settle these contracts. So people can settle these by refinancing, people can settle these from savings, or if you don't have those things available, you're going to have to sell your home, whether you like it or not, to move out. So what's the appeal on these? They're definitely faster to set up. Reverse mortgages do take time to get going. Often these companies can fund in, say, a little as 2 weeks. So if you're facing a really significant crunch, such as a medical bill or something like a foreclosure, these things can be an avenue. Another thing they have is they are actually available to homeowners under the age of 62. If you're brand new to the concept of HEAs, I recommend checking out all the resources I have in the description below. I go into detail on how these contracts work, review all the companies, and then have a pros and cons section to help you make a good financial decision here. I'm also going to link to a Consumer Financial Protection Bureau article about how some homeowners are not realizing what they're signing when they're getting into these things. All right, so let's start breaking these down side by side now. Let's start with the age requirement. With reverse mortgage, you have to be 62 years or older to qualify for a federally insured reverse mortgage. With an HEA, there's no age requirement. When it comes to repaying or settling these agreements with a reverse mortgage provider, you're essentially keeping that contract as long as you live in your home. You can buy out of it if you want, though. HEAs, on the other hand, have fixed terms, which you can buy out of early if you want, but at the end of this fixed term, it might be, say, 10 years, 20 years, 30 years. You do have to settle that agreement, and if you have no other funds available, then you would have to sell the home. So the big critical question here, if you want to age in place and you're looking at, say, a 10-year agreement, and that's only going to take you to, say, your mid-70s when you're expected to have good health, a home equity agreement might not be the best option. A reverse mortgage is going to give you a lot more flexibility in this scenario. But say you wish to exit the agreement pretty quick, that's when both options might be on the table. And then it's a matter of comparing the numbers. Next, let's look at the cost structure of these agreements. With the reverse mortgage, your interest is your cost essentially with these agreements, but you could end up keeping more of the future appreciation of your home. So with a home equity agreement, there's no interest, but what you are paying in here is the appreciation on your home's future value. And again, it's not a one-to-one exchange. You're usually giving up to, say, 10% of your home to somewhere around, it could be up to like 20%. So one thing with these is really the numbers are going to help make your decision, but I want to provide some more frameworks for making this decision, questions to ask yourself. So from a financial planning perspective, I like to ask myself questions here. The first question I want to ask is, how long do I want the solution to work? And that's going to really make a big impact on your choice. If you want that long-term stability, a reverse mortgage is really the clear winner here. There's no expiration to these as long as you live there. It's when you want to start running the numbers, when you're getting into more shorter term scenarios where you have a clear exit agreement. Reverse mortgages can still be exited early if you want to even maintain your home. But the thing is, you got to have the money to do so. Really, the main advantage of home equity agreements in the short term is their easy setup process, not necessarily the costs. So question number 2 is, how comfortable are you trading future home value for cash today? With the reverse mortgage, your outcome is going to be pretty standardized and you can plan a little bit more ahead because the numbers are more fixed than what you'd get with a home equity agreement. A home equity agreement is really a bet on how much appreciation your home is going to have. And keep in mind, more appreciation in both scenarios is better for you because you're the ultimate homeowner in that house. But then again, it's going to cost you more with a home equity agreement because you're sharing more of that upside. Question number 3 is, do you benefit from having all the cash up front, or is it better to, say, be a little more patient in terms of getting your withdrawals? And this is really where a reverse mortgage can shine. So if you take a lump sum from a home equity agreement or a reverse mortgage, you might have different qualifications for government benefits like Medicaid. So that might disqualify you from receiving any benefits. On the other hand, if you have a reverse mortgage and say you just take draws every month up to the monthly limit, you can still qualify for programs like Medicaid. So these are things to keep in mind in retirement. Last is, how does each option fit your estate planning goals? So if your goal is to eventually pass down your house, you want to involve your kids in this decision. Reverse mortgages do have some protections in place where you're never going to owe more than the home thanks to FHA insurance. HEAs are a little more complex to understand up front, and you want to make sure your heirs understand how to pay these off and when. Which kind of leads me to summing things up. You don't want to make this decision alone. For a reverse mortgage, you're actually required to get counseling, and that's a very good thing in my opinion. So for home equity agreements, there's no mandatory counseling, but I do recommend getting some help involved here. This could be from a family member, ideally a kid, to help get you on the same page, or a fiduciary advisor who can just help you run through the numbers. And one last thing I would say is sometimes the best answer is neither. Maybe it's downsizing, maybe it's going back to work, maybe it's exploring other assistance programs, maybe it's adjusting your budget. And look, I get it. These decisions are overwhelming, especially when you're dealing with a home that you may have been in for decades. So I've put together detailed guides on every HEA company. I've put together a more detailed guide on the website of comparisons between home equity agreements and reverse mortgages. I've linked in the description below to some good unbiased advice on these products. And I definitely recommend you checking these out because this is a very big financial decision. So with that said, if this video helped you understand these options better, of course, hit that subscribe button below. And of course, drop comments in the questions. I read every single one of them and often turn them into future videos. So one last thing, this isn't just about cash today. It's really about protecting your financial future as well. Take your time, get professional advice. And you really want to make the choice that's right for your short and long-term goals here. I'm RJ Weiss, certified financial planner and founder of the Ways to Wealth. Thanks for watching, and I'll see you next time.